I hate to be the bearer of bad news, but your taxes are probably going up. Earlier this year, President Biden released this 256-page document that's outlining how he's going to raise taxes on people making over $400,000 a year, how he wants to raise taxes on investors, and how he wants to raise taxes on corporations. Now you might say, well, what if Trump wins the election? He's going to cut taxes? Yes, President Trump says that he wants to cut taxes, although we don't have a definite plan on what this will actually look like if he wins. But what I'm talking about today is not political, it's financial. Let me show you. In 2024, the government is expected to spend $1.6 trillion that they don't have, and they're collecting about $4.9 trillion in taxes. So they're going to spend an additional $1.6 trillion that they don't collect from taxes. And in 2025, the government is expected to spend $1.8 trillion that they don't have. By the way, I got these numbers from the government budget office. Now you might be thinking, well, Jaspreet, the government has to spend this additional money because the government needs to spend money on things like firefighters and teachers and building bridges. But this begs the question, what is the government actually spending their money on? This is a chart that we published in our Market Briefs Pro newsletter showing the top 10 expenses for the United States government, and they are: number 1, Social Security; 2, health; 3, net interest; number 4, national defense, yes, the military; number 5, Medicare; 6, income security; 7, veterans benefits and services; 8, education, training, employment and social services; 9, transportation; 10, commerce and housing. I'm not sure if you caught that, but the third largest expense for the United States government is the interest expense that they're paying on all of our national debt. To put some numbers on this, in 2024, the United States government will spend $870 billion just on paying interest. That means out of the $4.9 trillion that they're collecting in taxes from taxpayers, 17% of your tax dollars are going directly just to pay interest. That's not building bridges or roads or firefighters or even the military. That's just paying back yesterday's expenses. Now you might look at this and say, well, that's not a good thing now, is it? But that's not even the worst part. The worst part is that this net interest expense is the fastest growing expense on the books for the United States government. If we take a look back at 2023, then we paid $658 billion in interest. In 2024, we're paying $870 billion in interest, more than $200 billion more. At this rate, it doesn't look like it'll be that long before half of every dollar that you pay in taxes are going to be used to pay back the government's credit card, national debt. And there are two reasons for this that we diagrammed in Market Briefs Pro, and I'll show you on charts here. The first reason is that the national debt in the United States has been exploding, especially after the pandemic. And number 2, the interest rates that the United States government has to pay on this debt has also grown significantly since the pandemic. Now, this might seem like a rhetorical question, but stick with me, you'll see why I'm asking this, because the question that we want to ask here is, all this government spending and payments in interest really a bad thing? And the answer is, well, it depends who you ask. If you ask some economists and some politicians, they'll tell you, no, it's not a bad thing, that the government should and has the ability to print essentially unlimited amounts of money, and that can help stimulate the economy and better the lives of people because the government can keep spending money in our economy. Now, being that most of the topics that I talk about on this channel are about how you can spend your money smartly, I have this kind of crazy belief that we should try to live within our own means, that we should not try to spend more money than we bring in. Let me just diagram this. In 2019, 5 years ago, the United States government spent, not collected, but actually spent $4.45 trillion. Then fast forward 5 years to 2019, the government is projected to spend $6.5 trillion. This is an increase in 46%, which, by the way, for you money nerds out there, is more than twice the speed at the reported inflation numbers. So now the question is, why is government spending increasing so quickly? Because we remember, well, the government spent money a lot in 2020, 2021, and 2022 because of the pandemic. But that pandemic really isn't here anymore. So why are we still spending at the pandemic rates? Well, one of the reasons for this is, of course, all the spending that we did during the pandemic. Now the government has to pay it back plus interest, along with a lot of other spending habits that the government has. It's nice to have free things. It's nice to have free college. It's nice to have free healthcare. It's nice to have free cars. It's nice to have free homes. It's nice to have free everything. But at the end of the day, there's a cost to everything. And the question is, how much should the government pay for versus how much should we pay for individually? And the only problem here is when the government spends money, they generally are not as efficient as private people. Now, sure, there are some instances where it'd be better for the government to spend money. There are some instances where it's better for people to spend money. But I think at the core, we have to understand, when is it better for the government to spend money? And then secondly, how can we make sure that the government is actually efficient with the money that they spend? Because unfortunately, most of the time, they're not. And a simple rule of thumb that I like to follow, that's kind of an underlying theme of all of my content, is you can't out-earn bad spending habits. And it's the same thing with the government. You cannot out-tax bad spending habits. And so now let's dig a little bit deeper to really understand now why this is all happening. And I do want to let you know, for those of you that do want to stay up to date on what is happening in the financial news, when it's happening, Market Briefs is a free resource that my team created to keep you up to date on what's happening with things like the economy, the housing market, stocks, crypto, and the global economy into a fun, witty, and easy to read newsletter. I got the link for you down in the description below. If we take a step back and look at how taxes have evolved, income taxes really went into effect back in 1913, the same year, for those of you that are money nerds, that the Federal Reserve Bank was created. So in 1913, the tax code said that you would pay a 1% tax on all income over $3,000 and a 6% tax on all income over $15 million. Now, if we adjust these numbers for inflation, what that means is you're paying a 1% tax on all incomes over around $90,000 in today's dollars, and a 6% tax on all incomes over $15 million in today's dollars. If you made under $90,000 in today's dollars, you would essentially be paying no taxes because you didn't make enough money to qualify for the income tax rule. Today, it doesn't matter how much money you make, you're paying taxes. So we've seen taxes rise over the last number of decades because we've seen government spending also rise. And in order to compensate for the higher government spending, the government needs more dollars. Because remember, the United States government has one source of income, and that source of income is tax dollars through taxpayers. So when the government wants to spend more money, they need more money. Now, this is where things kind of get a little bit more interesting and a little bit more complex, but if you stick with me, I'm going to try to break this down. That way it's as simple as possible to understand. Back in 1913 times, the United States dollar was also backed by physical gold. That means if the government wanted to spend money that they didn't have, it would be a little bit more difficult because then the government would need more wealth, in that case more gold, to justify borrowing more money. Like if you wanted to go out and borrow money, you need some sort of assets to show the bank that you can qualify for more money, right? You need a big home to say, hey, I have this home with equity in it, that way I can borrow more money. In this case, for the United States government, they needed that same thing, but back then money was backed by gold. Well, in 1971, the United States dollar was taken off of the gold standard by President Richard Nixon.
And the American economy is by far the strongest in the world. Accordingly, I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets.
And part of the reason for this was that Nixon needed more dollars to pay off some debts that the government had to pay. So the United States dollar was then severed from the gold standard. And this gave the government the ability to borrow essentially infinite amounts of money. Now, the question is, who are they borrowing money from? I mean, they can borrow money from you and me. If you go out and invest in treasury bonds, treasury bills, treasury notes, you are lending money to the United States government. But there aren't enough dollars in our economy from regular people to fund all the government spending. So that's when the government will also turn to other countries like Japan and China to borrow money. But still, they're not going to get enough money from these countries in addition to the investors in the United States, which is where the United States government will also work with the central bank in the United States, which is called the Federal Reserve Bank. Now, interestingly, they're called the Federal Reserve Bank, but they're actually not federal. It says so on their website. They're not a reserve because they're not sitting on cash reserves, and they're not a bank because you and I can't go there to deposit money. But the Federal Reserve Bank has the ability to print money out of thin air and lend it to the United States government. So now, if the government wants to spend billions of dollars or trillions of dollars that they don't have, before they'd have to produce more wealth, or they'd need more wealth in order to justify that additional borrowing. Now, they don't need to do that. They can just print this money through the help of the Federal Reserve Bank, who will then lend this money to the United States government, which was great because when the government injects money into the economy, that helps boost the economy. Because if you get a contract from the government to build a road, well, now you have a job. You can hire employees. You can buy more trucks. You can buy more cement. That stimulates the economy. So if the government is spending billions or trillions of dollars in the economy, that helps grow the economy. But that can also become a problem if the government keeps borrowing and borrowing and borrowing more money to keep fueling this stimulus, this boost in the economy. Because remember, it's debt, and the government has to pay back this debt, plus interest. We're now starting to see the consequences of this because after the pandemic, the United States government borrowed a lot of money and went into deep debt to fund the stimulus checks, to fund the unemployment programs, to fund the PPP programs, to fund the grants for businesses, to fund the bailouts. There was a lot of government spending that was happening to stimulate an economy that wasn't working. And so now we have an economy that's now working to generate dollars to not just pay for more spending, but to also pay back previous spending plus the higher interest rates. Because there's one more thing that you have to understand, that the United States government doesn't have just 30-year mortgages. Most of the government debt is shorter term loans. And what we saw is a lot of the debt that was issued during the pandemic was also short-term loans. We weren't locking in 30-year loans when interest rates were at the lowest rates ever. We were doing 2-year loans, 3-year loans, 5-year loans. And so now when we are in a situation today where interest rates are a whole lot higher, we have a large amount of government debt, which is now starting to readjust. And now when it's readjusting at the higher interest rates, that means the United States government has to pay back this debt at higher interest rates. But how does the government pay back that debt? Remember, the government gets their money from taxpayers through tax dollars, which means more tax dollars have to be used to pay back this debt. If they don't use tax dollars to pay back the debt, that means they would have to borrow money from somebody to pay back their debt. That's almost like paying off your Amex with your Visa. You can start to see why that would be a problem. And the reason why this is a concern is because the fastest growing expense that we have in the United States today is not something that's actually benefiting people. I mean, it's not infrastructure, it's not building public transit, it's not investing in technology, it's paying off interest. And that means more and more the tax dollars that we're paying is being used not to better our lives, but to pay back our previous expenses. And so this is where now it's a difficult conversation, because anytime we talk about government spending, if the government want to reduce spending, that means they'd have to give up some benefits. They might have to cut back on things like Social Security. They might have to not invest in infrastructure. They might have to not give money to countries overseas. They might have to not be able to pay for free schooling. And these things can be painful because everybody wants something for free, but like we talked about a lot during the pandemic, the most expensive kind of money is free money. Because when it's free, the person who pays the price is the person who doesn't understand where the money came from. And unfortunately, in today's society, most people have no idea of how our economic system works, of how money works, of how inflation works, and how the Federal Reserve Bank works. And if you don't understand these things, well, then you're the person that pays the price. Because when we have inflation, who does that benefit? Inflation benefits the financially educated. Inflation hurts the financially uneducated. And most of our country is financially uneducated. If you don't believe me, we can just take a look at the numbers. I mean, over the last number of years, incomes have barely kept up with inflation, if at all, because I think a lot of Americans have not seen their incomes grow fast enough to keep up with inflation. While at the same time, if we take a look at asset prices, you look at real estate prices, you look at stock prices, these have boomed as a byproduct of inflation. The S&P 500 is up around 80% over the last 5 years. Most people's incomes have barely grown by 20% over the last 5 years. So, the financially educated win, the financially uneducated make everybody else rich. And this is where it is so important for you to understand this. That way you can continue to build wealth for yourself and your family and your community. But that starts with you understanding the financial education of how the system works and how the government and the Federal Reserve Bank play a part in our economic system, because ultimately they are the entities that are in charge of helping to grow and build this system. And that's why your financial education is so important. And of course, if you want to stay up to date on what's happening, I got the link for you to join Market Briefs down in the description. I've spent more than a decade working to build my cash flow portfolio where my stocks pay me every quarter and my real estate pays me every month. Passive income is when you take your active income. This is the money you're making from your job or your business. You have some extra active income laying around, and then you're going to convert this dead active income that's doing nothing in your bank account to passive income, or we can call it cash flow.